Welcome to Kitco News. I'm Niels Christensen. What role does gold play in a portfolio now that the global economy is starting to slowly recover from the COVID-19 pandemic? Here to talk about his economic outlook is Tim Shaler, Chief Economist at iTrustCapital. Thank you very much for joining us today, Tim. It's a pleasure to speak to you again.
Likewise, thanks for having me.
The last time we talked, you mentioned something about statistical unknown. This was back in March when things were just starting to shut down. Since then, we've seen better than expected economic data, improvement in the labor markets. What are your thoughts on the economy right now, and how is that going to impact gold?
I think the tug of war that exists between short-term possible deflation with county officials in the U.S. and state officials in the U.S. choosing public health over economy has become the debate. Initially, there was not that really debate. It was, we're just going to protect public health. And there was not a lot of political to and fro about the ramification of closing the economy. As a political phenomenon, observed that Washington responded with literally trillions of dollars of stimulus, and the Federal Reserve literally created trillions of dollars in a very small amount of time as they responded to people wanting to hoard cash. So the Federal Reserve created that cash to stave off deflation. I think it's really important, especially for gold investors, to understand the risk of deflation. And I don't just mean because of the value of gold. I mean, if homeowners think that their home value is going to go down, and banks think that home values are going to go down, lots of people are going to recognize that banks are not going to want to lend against a deflating asset. So they won't lend. And so the Federal Reserve knows that. I would say that the best 7 or 8 central banks around the world are kind of like defense departments around the world. They are great at institutional knowledge, and we have learned a lot about monetary policy since the 1930s. And so all central banks recognize that it is way better to print trillions of dollars of money to prevent deflation. Ben Bernanke famously called this helicopter economics. He said it before he became a Federal Reserve chairman, but he became known as Helicopter Ben because of that. And the institutional knowledge created from his academic work is very strong. And so we're seeing that in action. The tug of war of preventing deflation today, on the one side, is tugging versus future inflation. And I would say that given that this is a US presidential election year, and given the political cost of rising interest rates in a political year, and the political cost of shutting down economies after they've been reopened, is widely recognized. Here in California, where I live, I would say the governor is getting very high marks from people on both sides of his social agenda politics because he recognizes that he really won't have the political wherewithal to close the economy again. So rather than opening fully and have the risk of not being able to close, he's doing a very slow phased in approach, largely in line with CDC recommendations. Whereas, if we've already said, in Georgia and Texas, there's possibly a risk that coronavirus and COVID-19 cases might come back faster than they otherwise would have. And because of all that, the risk of inflation caused by all this money that had been sitting in people's mattresses for the last 2 months might get spent. And the Federal Reserve will have political headwinds against being able to raise interest rates and soak up that money back out of the system, which would be positive for gold.
So I'd like to get your take on equity markets right now, and like we are seeing this exuberance. Some people have called it a mania in equities as sort of lockdown measures ease. Um, and I'm sort of wondering. I mean, what are your thoughts on that? I mean, obviously, the Fed uh, with its stimulus measures has really backstopped equities and compressed risk. Um, what does this environment look like for safe haven assets?
Safe haven assets, meaning US Treasury bonds and gold, are, I think it's important to remember that um, there are differing communities of buyers and sellers within each of those. So the gold market, for example, has one set of buyers who buys in case they need physical gold to make purchases if the economy literally breaks down. But there's others who own gold as a hedge against the US dollar falling. And I would say, to the extent that the risk that the US economy totally collapses goes down, um, and those uh, gold market participants might recognize that that risk is reducing, they might be selling. At the same time, the gold buyers who think about future inflation might be increasing buying. So I believe that if somebody is concerned about future inflation, that gold is an appropriate part of somebody's portfolio.
Let's turn to continue this talk about monetary policy. We're speaking actually ahead of the Federal Reserve's monetary policy decision. What are your expectations? I mean, they've thrown a lot of money into this, like you said, trillions of dollars on their balance sheet to protect the U.S. economy from deflation. Um, some people are now talking, as we've seen, sort of bond yields rise in this better than expected environment. Some people are now talking about yield control. What are your thoughts on what the Fed could do next?
Well, there's two parts to that question. One, I guess three parts. Regarding today's decision, I think the monetary policy decision will be a ho-hum event. It'll be we're keeping
Mhm.
interest rates pegged at between 0 and 0.25% for overnight rates in the U.S. The rate at which banks lend to each other. That's the rate that the Federal Reserve traditionally has directly manipulated. That's why it's called the Fed rate, even though it's the rate at which banks lend to each other, commercial banks.
Mhm.
I think what will be most interesting about today's meeting, though, is any kind of communication about what the Federal Reserve will do if we get closer back to full employment. Now, 21 million jobs is a lot of jobs for the economy in the US to soak back up. 21 million unemployed is way higher than it was 3 months ago. Now, the last unemployment report showed, as you said, 2.5 million job gains during the month of May, which was a fantastic report and quite a surprise to a lot of people, including myself. And the markets have rallied on that. And that's why politicians in the US can be crowing about a V shaped recovery. Um, However, the idea that we are going to get 21 million people back to work quickly, I think, um, I think the jury's out on that. And
Mhm.
but to the extent that those people do get back to work quickly, the interesting question for gold and bond markets will be what is the Federal Reserve going to do with interest rates? My thesis for thinking that gold makes sense within a portfolio rests on this idea that the Federal Reserve will choose to overshoot rather than risk deflation.
Mhm.
So, overshoot meaning the risk of inflation is far more palatable than any deflation. Um, and given that the US presidential election is only 5 months away, they have plenty of time after the election to raise interest rates if they need to.
This has been a fantastic conversation. I just wanted to ask you one more question. Um, Gold in a portfolio. We talk about these growing inflation risks. What do you think is sort of the magic number for for investors to hold? We hear 5 to 10%, but I'm sort of wondering, if we do see if the Fed errs on the side of inflation versus deflation, should investors be looking at being more overweight? Sort of being at the higher end of that category.
First of all, asset allocation is a whole set of topics that families need to discuss amongst themselves with financial advisors, tax advisors, legal advisors, et cetera. And it comes down to when is the family going to spend the money and why. My favorite example on this is if I'm 25 and I've just earned my first very large paycheck. Maybe I'm a young lawyer and I just won my first case. What do I do with my money? The advice is if you're alone, you don't have a boyfriend or girlfriend, and there's no prospect of having to buy a house anytime soon, put the whole thing away, put the whole thing in the stock market. 40 years from now, you're going to have a great retirement. But if you have a significant other and you look and it seems like this would be a great opportunity to start building up your down payment on your first house, then the exact opposite would be true. None of it should be in the bond market. None of it should be in the gold market. None of it should be in the stock market. And the whole thing should be sitting in a deposit at the bank until you save up enough money to buy your first house. And so, these discussions are long and complex, and it always comes down to what is the money for. Having said that, on the assumption that a typical family has about 60% allocated to stocks, 40% to bonds, they're thinking about leaving some of the money to their kids, I would say 10% allocation to gold makes a lot of sense because gold has a very low correlation to the overall stock market and to the overall bond market. And how portfolios decrease risk at a given return expectation or increase return expectation given a certain level of risk is by increasing the number of investments with low correlations to each other. So gold is typically a great investment with low correlations to other parts of the portfolio. So I like the 10% idea for people who want to buy gold, that 10% is enough to create a correlation factor within your portfolio, but it's not so high that it introduces new risk caused by fluctuations in the gold market itself.
Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.